All right. So I want to talk about some just creative things. Buy downs are becoming increasingly important. So we want to kind of go over just briefly what it looks like. So what's a buy down? Two types. Temporary, essentially it lowers the rate for 2, sometimes 3 years. Permanent, lowers the rate for the life of the loan. So how do temporary buy downs work? Well, this reduction in rate, 2% the first year and maybe 1% the second year. Rate remains at full note rate for the remainder of the loan. Payments reduced essentially years 1 and 2, and seller or lender pays a fee at the start of the loan to actually get you there. So here's an example. Say the rate today is 5.75. Well, year one would be 3.75, year two, 4.75, and year three, go back to that 5.75 would have been otherwise. And it gives just a rough balance of what that looked like with a $500,000 loan, putting 10% down. So you can see the monthly payment benefit, right? So it gives an idea. Now, it assumes that 10% of the loan and 2 points for the temporary buy down. Now, the buyer, the seller, or the lender could contribute to actually do that. Now, 2 points are equal to 2% of the loan amount. So if you have a loan amount of 500,000, 2% is $10,000, right? So this, just so you know, includes this principal and interest. Is I know we're national now, we're licensed, my branch even 24 states, but just gives kind of an idea here of what that may look like. Now, benefits temporary buy down, it keeps the payments lower in the early years of the loan. It could help the buyer qualify when income is expected to rise later. It can be paid off or paid for by the seller as a concession, pardon, and can allow for the seller to maintain a higher sales price, which is why we're seeing a lot, right? The seller can still sell the property they want for what they want it for, or what they hope to sell for, should I say. The buyer gets the payment that they want, the rate that they want with the temporary buy down. So how's it work with a permanent buy down? How does that work? So it's basically fee discount points are paid up front to lower the rate for life loan. Lower rate, lower payment, easier to qualify. It can be paid for by the buyer or seller. Now, 1 point equals 1% of the loan amount. Let's remember that. Okay. So here's an example. 500,000 down 10%, right? And then let's look at the right column. You see 480. Get an idea. Of course, back to 500,000. So we're going to see what that buy down looks like, right? The columns on the left are both at 5.75. Now, if they were to buy down at 5.25, right, this is where it helps the seller. They can pay the discount. They may net a little bit less, however, still better than selling the property for $480,000. Gives the buyer a better interest rate, right? That's kind of where that works out. So just an idea there. Um, I think it does, make sense for some. Here's a comparison of both the temporary and permanent buy down options versus a price reduction. So for sellers, this helps. If you're a seller and you're thinking about selling your property and you're having a tough time out there, I would share with you, this is a great way to sell your property, right? If you offer a seller concession, a seller credit, a seller buy down for your future home buyer, great way to sell your property, even in a slower market.